In the early 2000s, the American economy was buzzing. Home ownership was on the rise, largely due to banks extending loans to people who couldn't typically afford them. These subprime mortgages, as they were known, were bundled into complex financial instruments called mortgage-backed securities. Investors around the globe, attracted by the high returns, poured their money into these securities. However, as interest rates started to climb in the mid-2000s, homeowners began defaulting on their loans. The dominoes started to fall. Banks and investors who had invested heavily in these securities saw their investments plummet. This led to a liquidity crisis, where banks were hesitant to lend to each other due to the uncertainty of each other's solvency. The credit market froze, leading to the collapse of major financial institutions. Lehman Brothers, a prominent investment bank, filed for bankruptcy in September 2008, marking the pinnacle of the crisis. This sent shockwaves through the global economy, leading to massive layoffs and a severe recession. The government stepped in, implementing a massive $700 billion bailout plan to stabilize the financial system. This led to a heated debate about moral hazard, the idea that bailouts can encourage risky behavior since parties believe they will be saved if things go south. In the aftermath of the crisis, regulatory measures were put in place to prevent a recurrence. The Dodd-Frank Act, enacted in 2010, aimed at reducing the risk in the financial system by increasing transparency and accountability. So, what have we learned from the 2008 financial crisis? Firstly, the importance of prudent risk management. Financial institutions must be careful in their lending practices and avoid excessive risk-taking. Secondly, the need for strong regulatory oversight. Regulatory bodies must be vigilant in their monitoring of financial markets to detect and prevent potential crises. Lastly, the need for transparency. Investors need to understand the risks they are taking on. In conclusion, the financial crisis of 2008 was a wake-up call for the global economy. It underscored the interconnectedness of the world's financial systems and the devastating consequences of unchecked risk-taking. It is a chapter in our history that we must not forget, as the lessons it has imparted are crucial in preventing future financial catastrophes.